Good evening, all beautiful, intelligent women members, and welcome back once again on the Wednesday, our Sky High Symposium Series 9. So, since last 2 months, April, from 1st April, we are doing this Sky High Symposium. An excellent response from all of you. And this is our, 2 months we have already completed, and this is third month anniversary, and to celebrate that and share the knowledge on this completion of 2 months and starting of this third month of Sky High Symposium, we have with us CA Sudha Navanda, and who will be taking us through the opportunity as an insolvency professional and voluntary disclosure. She is in and out practicing in insolvency profession as a resolution professional, and also mainly into the voluntary liquidations. So what are the nitty-gritties in the going through this voluntary disclosure um, and through NCLT route, and why it is required, and what are the opportunities overall in the insolvency and bankruptcy code. So she will navigate us through the entire IBC and opportunities along with the voluntary dissolution. The second session we have with us CA Prerna Pishori, so who has been the chartered accountant, and also she has done the law from the Netherlands, and that course from the Netherlands, the speaker will introduce her in brief, but she has excellent knowledge in international taxation and FEMA. So I really welcome on behalf of all the participants and women members empowerment committee of Institute of Chartered Accountants of India to Sudhaji and Prernaji to having accepted our invitation to share their in-depth knowledge with all our members. Along with the faculties, we also have our very beloved coordinators who are also having a great experience in these fields. So we have with us the CA Kirti Agarwal, who is the past chairperson of Nagpur branch of the Institute of Chartered Accountants of India. We have with us CA Vrushali Shah, who is presently the managing committee member of Satara branch of ICAI, and CA Manisha Mange. And all these coordinators, really, I appreciate their time and effort to be with us to coordinate this session and to reach out to all the members for the queries or anything. Friends, once again, I request all of you to come and participate in our Sky High Symposium. This is mainly to give the opportunity to our CA women members to be part of this series and share their knowledge either as a faculty or come and take up the opportunity as a coordinator also, so that this will really motivate all the members who have taken the break or who want to do something after gaining the knowledge through this Sky High Symposium shared by various faculties. So it is my endeavor to serve the best to the members, and particularly to the female members through this Sky High Symposium and WMEC. With these words, I once again welcome all of you, and looking forward to see you all physically very soon. We have in the month of November World Congress, that is from IFAC. First time in India we are organizing at Geo Center, where we are expecting our Prime Minister Honorable Modi ji also to share his words of wisdom to our members. We are expecting at least 7,000 members participation, 5,000 from India and 2,000 from abroad also. So this is an excellent opportunity to network with all the members and gain the knowledge what all are having. So friends, looking forward to meet you in person very soon. With these words and welcome remarks, I give the charge of the session to our coordinators. Thank you.
Thank you. Thank you, Preeti ma'am, for your kind words. And now I would like to introduce CA Sudha Praveen Nawandar. I have got the opportunity to introduce her. So, chartered accountant in 1989, information systems audit from ICAI in year 2004, internal audit studies from Bombay Chartered Accountants Society in 2005, and she cleared exam of CPE from the State Board of Colorado, USA in 2007. Insolvency professional since 2017. So it is a big list of qualifications. Now, presently practicing since more than 30 years, uh, along with partners with Praveen R. Navandar and Company, based out of Mumbai. She is also a designated partner in IPA Saksham Insolvency Resolution LLP. Now, chartered accountant in practice since 1989, handling various audits and company law matters. As an insolvency professional, yes, she has handled 12 voluntary liquidations, including 5 multinational companies. That's really awesome. Presently handling one corporate insolvency resolution process, CIRP, of real estate company in Mumbai. Also authorized representative for a real estate company in Mumbai. Prepared more than 10 resolution plans and invited by Insolvency Bankruptcy Board of India, IBBI, at New Delhi in 2021 to address women insolvency professionals. Here are the great achievements and some other professional activities. Part of the resource person of WRC Annual Referencer IBC section 2021. Article on IBC published in Chambers of Income Tax Consultants, members of RIPA, that is Resolve Insolvency Professional Association, independent director of several companies, which include Anand Rathi Wells Limited, TVZ, Root Mobile Limited, and so on. The list goes on. The other participations in various table tennis player had participated intra-district level, then done Vipassana, Art of Living Landmark Forum courses, president of Rotary Club Mumbai Ghatkopar in 1718, founder of Women Entrepreneurs Club with women from different vocations, and not but I have no words, married to CA Praveen Namandarji, who is also an insolvency professional. Thank you, ma'am. I am just acknowledged to give you a brief introduction. Thank you. Now you can take the session forward. Our first session today is on voluntary liquidation and opportunities in IBC. So you can take forward the session from here. Thank you, ma'am.
Yeah. Thank you, Manisha, for your kind words and very nicely introduced.
Actually, we are privileged to have you here as a speaker, and your great experience, 30 years plus, so very good. I have no words, ma'am.
First of all, good evening to all. And I really congratulate Sri Priya Madam, who is the president of Women President for the Women Empowerment Group, and Preeti Madam, who is the vice chairperson, for conceiving this symposium. And the Sky High Symposium is so appropriate that women can reach the sky if they just take this path. So that is the thought behind it. And can we share give me the sharing rights? Okay. To share my PPT then.
Ruchi, can you please give technology team? Can you please give the sharing? Already there, Sudha madam.
Sudha ma'am, you are on mute.
Sudha ma'am, are you sharing or Rushali ma'am? I requested to Rushali ma'am also because you have shared the PPT with me, na?
Yeah. So if she
are
can
you
share, yeah, I can
Rushali
share.
ma'am?
I'm just trying. 1 minute.
Okay. Okay,
Yeah.
ma'am.
On the desktop, it's there. One minute. And full page.
Uh, Sudha ma'am, can Rushali ma'am share if you permit? Okay.
Hello.
Yeah. Now, can you see the screen?
Yes, ma'am.
Yes. Yeah.
Yes.
Yes. Sorry. So today we will take the voluntary liquidation process. This is a process which has been introduced through the newly introduced, like the Insolvency and Bankruptcy Code. Actually, now it is 5-year old. So this new IBC code was actually started from in the enforced from 1st December 2016, and however provisions related to voluntary liquidation were introduced from 1st April 2017. So like in the we have in Income Tax Act, the act and the rules. So here it is the code and the regulations. So anything you have to do at the act, you have to refer to the regulations. So the regulations are called the Insolvency and Bankruptcy Board of India Voluntary Liquidation Process Regulations. So what happened after the IBC came into picture? In the earlier regime, for any liquidation of any company, there was always involvement of judiciary. There was always delay and unending delays actually, and the capital was locked in, and even the assets which were there were just locked and keeping idle. So voluntary is a easy exit provided, wherein the judiciary here is the NCLT, the National Capital Company Law Tribunal. So they come into picture only after completion of the entire process. Before that, they are not there. So you are at your own speed and it is a well-defined program, so you can assure that it will get completed in time. That is a big relief. Now, who can undertake the liquidation? So any corporate person who is presently doing no commercial activity and who do not intend to do anything further, they just have, they are being bothered by the cost of annual compliances, always the fear the penalties will come. So those companies can take this exit route. Then there are many foreign holding companies which create the subsidiaries to do business in India. But after their work is done, or sometimes it is not feasible, they want to exit. So that is a very good mechanism of exiting the country and just liquidate the company. So we have done this recent company which has closed. They were actually into foreign exchange, providing foreign exchange platform to the entire country, and they are global players. But like since 4-5 years they were not doing any business, so we could complete this process, and the money which was locked, the capital into crores, has been released and given back to the shareholders. Then there's one medical company which has opened to do some cancer research and all, but they could not, the Indian model, they could not suit them. They were not able to grow their business. So they want to exit that company. So we are undertaking that right now. That is also a global, very famous player. So, and the third category, maybe the companies which have achieved its purpose. They were incorporated with some purpose, and now the purpose has been achieved, so they can exit. What are the main in just a glimpse of what involves voluntary liquidation involves? See, the insolvency professionals, they become the liquidator. Like professionals like us can become the liquidator. Then when the process starts, the company ceases to do any operations. Only where it's essential, then they take that only. And here it is a very time bound process. If there are creditors in the company, you have to pay them off. Then you have to complete this process with 270 days. Whereas where there are no creditors, in 90 days, you have to, from the starting of the process, you have to complete it. The records have to maintain for 8 years. That is one duty on us. So do I have to be slow or something? Is it okay?
No, it's okay, ma'am.
So the initiation process, first of all, the one thing we have to see that the company should not have committed any default. So it's a voluntary. So the promoters itself initiates this. So they have to ensure that the company has not ever done any default. And then they have to look into the affairs of the company, whether the assets are such which can pay off the liabilities. So if they are solvent in that sense, then they can take up this liquidation. So they have to, in the beginning, they have to study the balance sheets and all, and then they have to give a declaration that the company is solvent. It will be able to pay off the debt, or it has no debt. And secondly, it is not undertaking the liquidation to defraud anybody. Then they have to give this declaration to the board of directors before the board of directors meeting, along with the 2-year balance sheet and a copy of valuation. If they have done the valuation to know the value of their assets, then they have to give. And then the board has to evaluate and pass the resolution for initiation of voluntary liquidation. And after this, within 4 weeks of this board resolution, they have to call a meeting of the shareholders. And there the shareholders will pass the similar resolution that to undertake the voluntary liquidation and to appoint the liquidator, to approve the liquidator. So the day of passing of the special resolution is the liquidation commencement date. That is called the LCD, we may say. That day is very important because everything is linked to this date. Now, further, the shareholders have taken the resolution, but there are other creditors. So 2/3 of the creditors have to give their consent for this voluntary liquidation. Their approval is required, and then we can undertake the voluntary liquidation. This what we have. The resolution have to be filed with the ROC, and then we have to also inform the IBBI. This is here the reporting authority is Insolvency and Bankruptcy Board of India. So every important event we have to email to them, or sometimes send physical copy also. So similarly, if we have to file the ROC forms, and then we have to inform the IBBI that this of initiation of voluntary liquidation. So when the liquidator comes in, he has to within 5 days. It's a, you have to be really time bound. Within 5 days, you have to make public announcement in one regional newspaper and in one English newspaper. It's a daily widely read newspaper. And we have to state that it is the company is undertaking the voluntary liquidation. And if there are any claimants, they can file their claims. So why this is provided? Why this facility step is there? That it may be possible that the company has liabilities, but it has not recorded in the balance sheet. So as a liquidator, we will not know. But by public announcement, we can actually people can know and they can file their claim. So it is also safeguarding us and safeguarding the public, and it is also the correct thing to do. This announcement will also say the time period within which they have to file their claims. They have to file within 30 days. So this is one specimen of the public announcement. It is in Form A. It is a prescribed format. So we have to write the name of the company, the address, our the insolvency professional name will come, the date when it has started. That will also come, that is the process has started, and the date of submission of claim of 30 days we have to calculate and write here. So this is how it goes. Now the public announcement is done, and now the claims will start coming. So within 30 days of receiving the claims, we have to verify them. And if we have any additional requirement, we can mail to them. And if we have to, we are not satisfied with the claim, we can reject it, but we have to intimate them. Okay, the reasons for that. It is a very lot of effort has been done to prepare these regulations. Everything has been, formats have been given. So if they are operational creditors, if they're running business, they must have had old operational creditors, then they can file their claim in prescribed Form B. Like similarly, financial creditors are there. If they have any loans or anything is there, then Form C is there. And if they are workers, then they can file in Form D. And if there is a representative of workers or employees, then Form E can be filed. And there may be other type of stakeholders who are neither in the above categories. Then like, advance given for any work or any deposits, then they can write here the other stakeholders in Form F, the Form F. Having verified the claims, our list of creditors is ready. So we have been given 45 days from the last date of receipt of claim. So last date of receipt of claim, after that 45 days, you have to prepare the list of stakeholders. Who are the operational creditors? Who are the financial creditors? Other stakeholders? Everything we have to give in table and give to the IBBI. And say there are no creditors, no claims have come. Then within 15 days, we have to prepare the list and upload it, email it to the IBBI. This actually, the list is very important and it forms part of the final petition to the NCLT also. Now, till yet the bank was operated by the directors, but once we are appointed, we have to take charge of the bank account. So we have open a new bank account, and in that bank account itself, we put the suffix involuntary liquidation. So it will be XYZ Private Limited involuntary liquidation. And actually, when we are appointed, immediately in the same day or second day, we write the mail to the existing bankers that only we will be operating and do not allow any transactions in accounts. So we have to take the information from the directors beforehand, before we commence. Actually, lot of work is done before we commence this voluntary liquidation. We actually study the balance sheet beforehand. We tell the directors that in the financial year, you clear all the accounts, pay all the liabilities, make it the balance sheet very light, close the unnecessary bank account, and then you start the voluntary liquidation. So then in that case, it goes smoothly and the work for us is also reduced. So now there's one other possibility is there, that in the existing bank account also, if you want to continue, you can get the name changed, the nomenclature changed, the same name, and in that you can add involuntary liquidation. In this, the liquidator will be the sole signatory. So one has to be very careful about, because the amounts are huge sometimes in crores, you have to keep the checkbooks like in your custody, and very vigilant one has to be while making the payments. Then next is the intimation to income tax. Yeah, income tax department, it is mandatory as per Income Tax Act under section 178 to inform the ITO within 30 days of the commencement of liquidation. So till now, till November 21, we have to obtain the NOC from income tax that there is no dues and you can go ahead with the voluntary liquidation. So it was a very tedious process. Sometimes we used to get like, within a month or two, but sometimes it is actually taken 2 years and we have not received the NOC. So we have to actually literally, I had to go for some companies, foreign subsidiaries, that we have to go myself to this department to get this. Otherwise, to get the NOC, because otherwise the whole process is stuck up. Because this NOC was required by the judges. The first thing, have you got the income tax NOC? So we had to show to them. So we could not close the company because of one document of NOC of income tax. So thanks to IBBI wisdom, they realized that the whole process is being delayed just for this. So they have done away with this by releasing a circular on 15 November 21. So doing away with the requirement. Then when we file the ROC forms, we have to ensure that the status on the MC data changes to under liquidation. So that master data ka printout we have to give in the NCLT filing. Then the next is the preliminary report. One has to prepare a preliminary report from the starting LCD, the liquidation commencement date. Within 45 days of that, you have to file a preliminary report, and which will contain the shareholding pattern, what are the estimated assets and liabilities. So that report has to be prepared. Then there are many other documents which has to be prepared. Like if you are during the process of meeting, if you want to inquire with the stakeholders and you want to inform them how you will be distributing the asset, then we have to keep a meeting and we have to maintain the minutes of the consultation with stakeholders. Then there are other reports which we will see as we move ahead. Now, when the assets have been realized, then we have to distribute. We have to first of all pay to the creditors. And now within 30 days, we have to pay to the shareholders also. So this amendment has come from last month only, 5th April. Earlier, it was 6 months were given for distribution of assets, realized assets. Now it is just 30 days. But sometimes it is not possible to realize the asset and distribute. We can actually, or it is not feasible, or it is not advantageous, or financially correct because then we can do directly, we can distribute the asset. We have been got an opportunity to distribute a flat, a Bombay prime area flat to the shareholder, because sometimes the company itself is formed to keep that flat or any asset. They don't intend to actually liquidate it. So we have given it to shareholder. They have a mutual fund units we can give to shareholders directly. So we have to distribute the proceeds, and for some reason we are not able to distribute the proceeds due to shareholder not traceable or any reason, a foreign shareholder not traceable, then we can park the funds in corporate voluntary liquidation account. Because this is required, because we have to distribute, make the bank account zero, and then we have to close then the voluntary liquidation process is closed. When the account is becoming zero, we have to get the audit done of the liquidation period from the opening, from the date, LCD date to the bank account closing date. So this is there that we have to complete. Actually, when there are creditors, we have to complete in 270 days. But however, if there are no creditors, as I said before also, it is 90 days only. That is 3 months. Now what happens if for some reason it does not get over in 12 months, this liquidation process, then we shall have to hold a meeting of the contributories, that is the shareholders. It has to be held within 15 days from the end of the 12 months. We have to hold a meeting. We have to get the accounts audited till that date. And we have to, that is called and we have to prepare annual status report. That's 12 months have ended. What is the annual report? What is the status of the liquidation process? Whether we have received the liabilities, any claims have been received, or what further process is remaining, how we plan to move ahead. Everything has to be given in the annual status report. And the minutes have to be maintained of this meeting of the shareholders, and it's a part of, all documents are part of the final petition to the NCLT. So when the assets have been distributed, the funds are zero, now bank account is closed, we have to prepare the final report, and the final report has to be submitted physically to the registrar of companies, and also physically we have to courier it to IBBI. Also we have to upload an ROC form with the final report. Now final report is actually will constitute of the accounts, audited accounts, as I said, of the liquidation period. So we have to appoint a new auditor. The old auditor will not continue. It is mandatory, it is required by regulation 11 that you have to, the prior auditors cannot be continued. It has to be, he has to be independent. And this final report that we are preparing, it will contain statement of the what are the assets and what are the liabilities. And second statement will be what you have realized, what is the cost of realization, what is the manner and mode of sale, and to whom you have sold. Everything has to be given, submitted. So the IBBI is one thing, they examine every document. They get, queries are raised, you have to answer them. In inspection, they do the inspection, see all the files, how you have maintained. Now, once the final report is done, now we have to file the petition with NCLT. For this is for the dissolution of the company. This petition will have an affidavit signed by the liquidator, that is us professionals, that everything is correct and true, and this has to be submitted. And then NCLT will give us a date for hearing, and we have to go to NCLT, and now presently it is being taken online. So we have to appear ourselves. We can appear ourselves. There's also a good opportunity. We can and present our case, that how we did, what we did. And then if they approve, we get the dissolution order. We can also hire any advocate or any CA for representing this matter. And records have to be maintained for 8 years. Here, there is one corporate insolvency process, and this is a voluntary liquidation. So here it is time bound, and even the fees is time bound. Like, it's a lump sum amount. When the insolvency process is every month, you get the fee. So here, actually, there's no benefit also of prolonging this liquidation, voluntary liquidation. You get the assignment, you can get, if there are no creditors, within 90 days, you can do the work, you'll be free and get your fees. So this is about the voluntary liquidation. If you have any queries, I'm happy to answer on this.
Hello, ma'am. One query has been received. And one of the participants, she has requested that can you cite some practical example?
Yeah. See, we have followed exactly the same procedure. The actually balance sheet is first we have. So yeah, we can share. See, one company is into cereal production. It's a Bombay-based company, but their cereal productions was done in Kolkata. So when we made the public announcement, we did in Mumbai as well as in Kolkata because the business was there. So that we did. So this is one, and then we could actually we have it was very difficult to open a bank account in the beginning because the banks were not understanding what is this liquidation and why the signatory will be you people, and there's no intervention of directors. So it was very difficult to get the legal sanction to open the account. Actually, three months were passing without opening the account. It was very cumbersome in the beginning, actually. Everything, actually, the formats of the stakeholders, everything we had to struggle. And how to prepare the formats and all. So in this income tax NOC, every week we used to send a person to do the follow-up. Then the problem comes of master data. So currently we are undertaking a company in which it has been filed in July 20. The initiation of voluntary has taken in July 20, but till like last week they have not updated the master data into under liquidation. Generally, when we file the ROC forms in the beginning, when the forms get approved, after some time they change it to under liquidation. But here after repeated follow-up of over a year, they were not ready to change it. Ultimately, we used to write emails to ROC, registrar, and now what has happened? The entire process is closed. The bank account is closed, audit is done, but only one document, that master data, is not changed under liquidation. We could not file the final petition to NCLT. So now we have been able to do it. So there are actually challenges are many. Because but what company I told you in Kolkata, that company's bank accounts were in Kolkata. There were 2-3 bank accounts. So to get their details and to correspond with them to get the bank statements, it was also challenging to get the details from Kolkata. Because we had to stop the transactions, and they were not reachable. We could not get the bank account contact number. So that was, you're skeptical because the moment you are appointed, the assets come under your control. So these many actually challenges come. So one other challenge what we have faced is the refund. Now one company is there, it's a foreign subsidiary of UAE, a big company, and they are not getting the income tax refund from now 3 years. That started in April 18, but there no refund has been received of around more than 20 lakhs. So we are not able to close the company. So every year we have to call the annual meeting. After 12 months, we have to call the meeting. We have to prepare the annual status report, get the audit done every year. But there is no, the fees is lump sum. But then we have, since we have taken the assignment, we have to complete it. So actually, that some issues are such that we get stuck up and nothing can be done.
Ma'am, one more participant wants to know as to who can be appointed as a liquidator. Means it can be company auditor itself or someone else.
No, it is actually the insolvency professional. Ones who have just cleared this exam of insolvency, which is the program, the exam conducted by IBBI syllabus. So that exam one has to clear.
If the person
And
is already holding that company's, like he is already the auditor of that company, then can he continue, or it has to be some another person than the company's auditor if he has that qualification.
no, then he cannot actually be liquidator. If he has been an auditor, then he cannot be liquidator. Yeah, he has to be independent person.
Yes, right, ma'am.
Yeah.
Ma'am, can we go to opportunities?
Yes, yes. So as we opportunities are many in IBC, the first and foremost is we should read the IBC, the Insolvency and Bankruptcy Code. The beauty of this is the IBBI website. If you just log in into IBBI website, and there the resource, the act and regulations are given just by drop down. And the beauty of this is that act is like, it's always updated act they posted. Whatever amendments come, they incorporate and post it with the date. So, and that they mention that the previous provision was this, that is also mentioned below in the footnote. So you always get that. It's very well made document. So you have to read the code first, and it is freely available on the IBBI website. Now, as we discussed, see, when we talked about the claims, the public announcement and the claims. Now, preparation of claim itself is a task. People are not, do not have knowledge, and there's quite a lot of information being asked. So one can prepare claim and do the submit. So when the case that we are handling, this real estate matter of corporate insolvency, there are more than around 100 home buyers. So they have to prepare the claim and submit. So that task one can take per claim form, they can charge and take this work. Then that is from the claimant point of view. But you can join hands with any of the insolvency professional, and you can do, even if you are not qualified as insolvent profession, just CA. These work are all mostly which CA can do. He can render his services as verifying the claims. He can verify the claims, write the emails to the claimants. So this is also one big aspect, because it's so time bound. Within 30 days, you have to verify the claims, right? So this work can be taken up by the CAs. And if you're a register valuer, then you can do valuation. Valuation is required in the corporate. See, I have given the headings also. Corporate insolvency resolution. When the companies take the faces the corporate insolvency, then valuation has to be done of the assets in the beginning itself. Even in the voluntary liquidation, when the directors take the initiation, they have to get the valuation done. So valuation has a good chance to be associated in IBC matters. Like these authorized representative, the fourth category. Now, what is this? Say, now presently there is one real estate company which are having more than 200 flat owners. So in the public announcement, what we make, the insolvency professional makes the public announcement, he gives the name itself, that who will be the authorized representative for these flat owners. So when the flat owners fill their claim forms, they choose they are who will be my authorized representative. So we can be authorized representative of the flat home buyers. So this is the authorized, like presently I'm handling a real estate matter where I am the authorized representative. So whatever queries they have to call us and we can answer them. So what happens, the main insolvency professional is not bothered, and even in the meetings, only the authorized representative will go to the meeting. The entire class of flat owners cannot go. So big one can be authorized representative. Then when these companies which goes into insolvency, there are many buyers who are in similar industry or are in the same area, and they can acquire that company. When this company undergoing CIRP, it is called, they release an expression of interest that anybody interested can file their plan of action. So that preparing the resolution, that is called resolution plan. So this is also a big opportunity that you can prepare resolution plan, that like what you have to just study the balance sheet of the company, and what are the claims and how you will be paying them. Everything has to be put in the plan, and that is called buy side advisory. So this is also an opportunity, and there is no any CA can do this work. Now the buy side, someone has acquired the company. Now what? Now he has to the resolution plan that he had submitted earlier, or all action has to be taken according to that. It has to be strictly adhered to. So that is also one opportunity of implementing the resolution plan. So example, we had taken a resolution plan like 3 years back. One company, we had prepared the resolution plan, and that our client had acquired one company under insolvency. So that work was over, but still we are there helping them in implementing the resolution plan after 3 years also, because so many issues come up. There are workers issues, there are GST issues everywhere, the land issues. So they have continued with us because we had the knowledge of their problems, and so that you continue. So every month we are a retainer to them. So this is a big opportunity and continuous opportunity. Even there are so many procedures. When you take this, voluntary is a small, this thing which can be handled by a small team, but when you take the CRP, the corporate insolvency, like you must have heard SR Steel went into CIRP. So what, imagine the number of work. There must be 100 people working for the insolvency professional to manage this one SR Steel. So one, for smaller one also, we can take the CRP support we can give. That is also one big task. Now, other thing that we see what the insolvency bank, IBC, what it proposes is that whatever it is business into, you should continue the business of when it is into company has gone into insolvency, and if it is into running business, like SR Steel, they will continue it with the business. They will not stop, can't stop even for a day. Then there you have to continue the business. Then all services are required for a business. What we require for normal, this also require the same thing. The audit services are required. GST compliances have to be done. The ROC compliances have to be done. Accounting have to be done. Even accounting work is a big thing. You can take that also. ROC compliances, that IBBI compliances, they are all services have to be required. HR services, whatever. You can give the services, CIRP support. Then what I referred, that we have to represent in tribunals. So for my voluntary liquidation assignment, I always gotten, we never actually CA, we never visited the court and all. But this IBC gave me the opportunity to myself represent, because I did the process myself. I was much more equipped to answer to any question that the judge may raise. So I represented to tribunals. Now I am quite comfortable. We can go and attend the tribunals. So this new opportunity opens up. But fear of what we have, fear that also goes away once we have to just face it once. So for the companies, it is the NCLT National Company Law Tribunal, and for the individual cases, some individual insolvencies there, like personal guarantor and all, then you have to go to Debt Recovery Tribunal, DRT, and you can represent your client there. So every representation, you can charge a separate fee. So when the company, this big company, say SR Steel, which we are taking the example, now when there are huge information is gathered by the insolvency professional, and then he has to release an expression of interest. So whosoever shows interest, he will need all the information. So they have information memorandum is prepared. It captures all the information which the insolvency professional has gathered, and that is shared with the new applicant who want to buy the business. So we can assist in preparation of information memorandum. Then forensic audit, where there are fraudulent transactions, preferential transactions, then you have to take the forensic audit. So forensic audit is mostly in big companies. Under IBC, this forensic audit is done. Internal audit, continuation process. Sometimes the unit is far away. We are here. Sometimes I got an assignment for, like, in Kolkata. So that is also possible. Now then you have to see what happens in such cases. Say you are in one city and you get an assignment in another city. So what we generally do, we hire a local CA of that area. He does the coordination, the appointment of security, auditor over there, any work, you go to the income tax department, everything is done by the CA. And now it has happened now over the period that such CAs in local area, they have become so expert, they are providing search services for 4,4, 5 companies. So this is also one which it is required the same work which we are already doing as CA, and here you can look after the IBC company, and it's an excellent opportunity. Conducting due diligence. Now, anyone who wants to buy a company, he will require due diligence. So we can render our services. We use our expertise over there. Strategy consult. Yes, it requires a lot of strategy. When you have to acquire a company, there may be 3-4 people who may be interested for buying that company. The strategy is required. What quotation to put, then what other will put, we have to envisage. Again, we have to change the quotation. So it's a very challenging thing. So that also, depending on your financial acumen and your ability in that direction, you can take this assignment. Now the FEMA compliances also come in. When there are foreign subsidiaries, after we have made the payments, you have to file the FCTRS forms. The FEMA compliances have to be done. So there comes the role of the FEMA expertise, which is also now the next talk also. So this is about in brief about the opportunities, and I wish many more people can just take up these opportunities.
Thank you, Sudha ma'am. Really, it has been a wonderful session, and now the comments that I can view, instead of questions, I am having more comments regarding and that they have really understood the subject, getting knowledge about new opportunities in this, and so we are really delighted. And really, I would like to convey my heartfelt thanks to you, CA Sudha Namandar, Honorable Speaker, for this session on voluntary liquidation and opportunities in IBC. Brilliant session, ma'am. And thank you for those practical inputs also. You really I thank you from the core of my heart for your valuable time. And now I would. There is another session also, and we are also
Yes.
delighted to have Prerna ma'am, who has already
Thank
joined.
you, everybody. Yes.
I request CA Kirti Agrawal to please introduce CA Prerna Pishori for the next session. Thank you.
Thank you, Rushali. Thank you, Sudha ma'am. It was a brilliant session. Even I wasn't aware of so many opportunities that a normal CA, not being an IB professional, can get into this
Yes.
kind of assignments. And hopefully, I would, but still pray that Nagpur don't have much of the IBC cases in future also. but we are seeing, and so many cases are coming up, and the bank fraud and the company is going into liquidation and all that stuff. So there is ample opportunity in every city, I must say, not just metro or big cities, but even tier 2, tier 3 cities. So here, as a female member, we can definitely look into this opportunity. It was a wonderful session, ma'am. Thank you, Roshali, for the opportunity. And I would thank the Preeti ma'am for giving us the opportunity as being a coordinator for the Women's Series Sky High Symposium, which is going on very well for all the women across the nation. And it's my privilege to introduce our today's speaker for the second session, CA Prerna Peshori ma'am. She is it's a brilliant and excellent speaker, because she is not just an multi-talented and multi-degree holder, but I can see from her profile that she has been delivering lectures and not just giving services to the clients. I'll take this opportunity to introduce her. She is a chartered accountant, LLB, LLM in international taxation from Vienna. She have done her diploma in international taxation. She is an MCOM. She is practicing chartered accountant and is also an international tax lawyer. She is a partner of Peshori, Pachori and Jain. She has experience in international taxation advisory, transfer pricing, cross-border transactions, advisory and structuring, deal and startup advisory, litigation. She has completed a master's from Western Union, Vienna as Foundation for International Tax Scholar in 2019. She is delivering lectures at various professional forums and has been teaching international tax law to chartered accountants and advanced diploma in international tax UK students also. She has been a guest lecturer in several national law universities. She is being selected as 35 future leaders in taxation by Tax Group. She has authored many papers and books on direct and international taxation. She has been awarded at an International Research Award by our very own alma mater, ICAI. Presently, she is a convener of International Study Committee at CTC and International Fiscal Association and Bombay Chartered Accountant Association Society. It's a privilege to welcome you, ma'am. Thank you so much.
Thank you so
Over
much,
to you,
ma'am.
ma'am.
Yeah, thank you so much for the introduction, and thanks to Preeti ma'am for this particular lecture. So let's get quickly started. My topic today is TDS on NRI payments and the Form 15 CACB regulations. So I think this topic is very, very relevant because we face day to day these particular payments are received. We have to issue a lot of certificates. So this is very, very relevant topic for all of us. So let me just quickly share the screen. I hope the screen is visible. Okay. Yeah, so this is what first we are going to cover section 195, where this TDS obligation arises for the non-resident. So as you would be aware that whenever we make the payments to the non-resident, we have to deduct the taxes if the income is chargeable to tax under section 195. Of course, there are other sections also for certain other categories of income, but more or less we have this particular section. So who is covered over here? Any person who is responsible for paying to a non-resident or a foreign company. Now, does it even include a non-resident paying to another non-resident? Say, for example, there is a foreign company which is purchasing the shares from another foreign company of an Indian company. So there are two foreign companies involved who are buyer and seller. The transaction is taking place outside India. Everything else is the agreements, contracts are done outside India. The consideration is paid outside India, but the shares were purchased of the Indian company. Whether in that case the 195 would be applicable, whether the non-resident buyer has an obligation to deduct the taxes while making the payment to the non-resident seller, the answer is yes. So even in a case where the non-resident are involved, both the parties are non-resident and none of them is resident, in that case also this particular transaction will be subject to TDS under section 195. So 195 covers any person. It's not just that only while the resident is making the payment, any person who is responsible for paying. So it includes a non-resident also. So the presence of non-resident in India is not really important. It doesn't matter whether the non-resident has any PE, business connection or residence or any particular presence in India or not. If the income is chargeable to tax in India, only that shall suffice. So even if one non-resident is making payment to another NR, the same will be covered. What about a foreign company having the residence in India by virtue of having the POEM in India? Even that shall be covered. So the notification to section 115JH also talks about the same thing. It says that even where the foreign company is becoming a resident in India by virtue of it having a POEM in India, in that situation also, not the other sections of residents will apply, but 195 will continue to be applicable. So just because the company is becoming resident in India, the other TDS section will not apply and 195 only will be applicable. So therefore, when we are making the payment to a non-resident, even where it is resident, who has a foreign company which has become resident, or even when one non-resident is making payment to another non-resident, in all these situations, the TDS will be applicable. Second thing is that you may say that, okay, this is an extraterritorial operation. Vodafone case was there of Supreme Court, wherein it was held that this particular 195 will not be applicable. But amendment was specifically introduced under 195 to provide that whether or not non-resident has presence in India, if the payment is being made to non-resident and the income is chargeable to tax, 195 will be applicable. So that is about the who is covered under 195. Now, what is covered? It says sums chargeable to tax. So it's not that every payment which is being made to a non-resident is covered. So any interest or any other sum which is chargeable to tax other than the interest income which are paid to the infrastructure, which are arising on infrastructure debt fund or payment from Indian company or on certain bonds or income from GDRs or offshore funds or payments to sports persons, salaries, all these are not covered. They are covered by certain specific section. But other than that, any other interest or any other sum chargeable to tax is covered. So the point here is that the sum chargeable to tax. So if the sum is chargeable to tax, that is covered. So what about the payments which are exempt from TDS? Whether in that case, 195 will not be applicable. So 195 will be applicable only on incomes which are chargeable to tax. Now, once I say income which are chargeable to tax, here there is no threshold limit. Unlike 194J, 194C, where we have the threshold limit, here there is no threshold limit. Even if 1 rupee is being paid to a non-resident, 195 will be applicable. So it is without any threshold limit. What is not covered here, as I said, exempt income. Also, not everything requires deduction of taxes. So we will talk about it in detail. But just to give a brief overview, not everything is covered under some chargeable to tax. Whether it includes GST or service tax on the invoices. So if the invoice consists of the particular transaction and the payment for that, plus the service tax or GST has been charged on that. So whether on the GST also TDS has to be deducted, the answer is no. GST is not income. It is not part of the income chargeable to tax. So therefore, no TDS on service tax or GST. Now, one of the biggest questions which arises in case of 195 is that here, what is the sum chargeable to tax? Whether, if say for example, I'm making the payment for purchases. If I'm making the payment for the purchase of a capital asset. If say for example, one non-resident has sold the house. Now the buyer is an Indian resident or he could be a non-resident. In that case, when I'm purchasing a capital asset, when I'm purchasing residential house from non-resident, this is very common issue which arises. In that case, whether we should deduct the taxes on the entire amount of the particular house or on the capital gain. So the question which arises generally is whether on the sale consideration what the buyer is paying, on that the tax should be deducted or on the capital gain amount. So for that, Supreme Court in Transmission Corporation of India and GE Technology case had clearly held that the tax is to be deducted not just from the payments which are wholly income, but also from payments where only a portion of payment may be income. So if, say, for example, under the sale consideration, your sale consideration entirely is not income of the non-resident seller. What is income is the capital gain. So in Transmission Corporation, it was clearly held by the Supreme Court that the deduction of tax is not just restricted only on the income amount, it is also on the payment which comprises or which includes the income amount, like the composite payments. So now how do you determine what is the income and what is not the income? On what portion you have to deduct the taxes? That becomes the question. So for that, if the buyer is aware about the capital gain, he could compute it, he could ask for the documents from the seller. But if he is not aware, he can make an application to the assessing officer to determine the sum chargeable to tax. So application can be made under section 195(2) by the payer. So the payer needs to make an application. Now there was one view that if the application is not made, then on the whole of the sum, whether the TDS should be deductible. So Karnataka High Court and Samsung Electronics had held that payment to the non-resident are subject to the TDS on the whole of the sum if the payer doesn't obtain the certificate from the AO. But that decision was overruled in G Technologies case that it is not really required to deduct the tax on the whole payment. So only on the sum which is chargeable to tax, only on that portion you need to deduct the taxes. And application to the AO is not mandatory. It is only necessary when the payer is unsure of the portion of payment which should be subject to withholding tax. So 195(2), the application to the AO by the payer is only a safeguard. Also, there are CPE circular which clearly say that even for the interest portion under section 2011A, will be on the portion which is representing the income and not on the entire sum. Similarly, another CPE circular talks about that disallowance under 40AI or 40A1 will be on the sums which are chargeable to tax and not on the whole amount. So which denotes that when you are not sure as to what is the sum chargeable to tax, you can make an application to the AO to determine what is the sum chargeable to tax, and it is not to be deducted on the entire sale consideration but on the capital gain amount. So that's very, very clear. So just I have put up one case study over here that if Mr. X, an NRI, purchases a flat from Mr. Y, who is another NRI, or even a resident purchases a flat from another NRI, whether the TDS is applicable and on what amount. So as I said, one view was that, okay, TDS should be on the sale proceed. However, the counter view is that it should be on only the capital gain amount. And for that, the payer can make a reference to the AO, can approach the tax officer under 195(2) if he is not able to determine the capital gain amount. So it should not be on the entire sale consideration. But honestly, what people do is most of the time they just deduct on the sale consideration to be on the safer side because TDS obligations are very onerous. Then the second thing is that on when it is applicable, when particular 195 is applicable. So it is applicable just like other section at the time of payment or credit, whichever is earlier. So 195 is also applicable at the time of payment or credit, whatever is earlier. Also, there are decisions, for example, when the FEMA or RBI approval is required before remitting the amount. In that case, when TDS should be deducted. So if, say, for example, certain companies require the remittance approval before they are remitting the dividend amount. In that particular case, when exactly the TDS needs to be deducted, whether it is to be on the obtaining the approval or it should be on the payment which is being made or the credit it is being made. So when exactly the particular TDS has to be deducted. So it has been held that the TDS in cases where the approval is required on remittances, where the approval from RBI is required on remittance, in that particular case, the TDS has to be deducted when the particular payment is credited, because it's just that the approval is required for the remittance purpose. The amount has already been credited. So in that particular case, the decision is there which says that yes, the TDS, the TDS would be required on FEMA, or TDS would be required on particular payment being credited. This is a decision of Delhi Tribunal in United Breweries Limited. There are also the cases where the government approval is required. It was a decision of Bombay High Court in Pfizer Corporation, where the Pfizer Corporation received dividends from its subsidiary in India. The dividends were declared and actual remittances were made with the permission of the RBI. So in that case, the Bombay High Court said that the TDS has to be on the grant of the approval, because here the approval was not on remittance but on the declaration itself. So if the declaration itself, the approval is required, in that case, it will be only when the approval is granted. So only when the payment is made, only in that case, the TDS will be deducted. So these are some of the issues which arises when exactly the payment TDS should be deducted, whether on payment or whether on the credit. Then what is the rate? Rate here is rates in force. So here the rate is as per the rates in force. Now what are the rates in force? Rates in force are the part 2 to the first schedule of the Finance Act. They are defined under section 237A, or the DTAA rates, whichever is beneficial. Whether surcharge is to be added to the DTAA rates, whether the surcharge needs to be added, the answer is yes, if the rates are as per the Finance Act. If the rate is as per the DTAA, then the surcharge may not be added, because if the rate is as per the DTAA, that's the final rate. So rates in force, if it is as per the first schedule of the Finance Act, yes, surcharge needs to be added. Surcharge does not need to be added to the DTAA. Even the education cess need not be added to the DTAA rate. Now, next is the applicability of section 206AA. If the non-resident does not have a PAN, then in that case, 206AA becomes applicable. Now, 206AA provides for higher withholding taxes where you do not have PAN. It is a non-obstant provision which starts with notwithstanding anything. So any person who is not furnishing the PAN, he needs to bear the higher withholding taxes. So tax shall be deducted at the higher of rates under the Act, rates in force, or 20%. And then whenever you're filing a return, you can obtain the refund of the higher tax deducted. Now the question in that case arises that if the higher withholding tax is as per 206AA, whether it overrides the DTAA rate, because DTAA always provides for a lower withholding taxes usually. So in that case, whether the lower withholding tax of the DTAA will be applicable or of 206AA, that is the question. So in that case, we have decision which says that 206AA, one view is that it cannot override the treaty obligation. So 206AA will not override the treaty obligation. That is one view. However, literal reading will suggest that because it's a non-withstanding clause, it shall have the overriding effect over the provisions of the Act, including the tax treaty, because it overrides all other sections. So there are two alternate views which are there. Also, on 206AA, whether surcharge and education cess will be topped up, it is not to be included, because 206AA is not included for the purpose of surcharge and education cess under the Finance Act. Only if the tax is as per the rates in force, then only surcharge and education cess will be applicable. Also, now there is a relaxation for the non-residents if they provide certain information which is specified, and if they provide the tax residency certificate and tax identification number, and if they have income from interest, royalty, FTS, capital gain, interest on long-term infrastructure bond, in that particular case, if they provide these information, 206AA will not be applicable to them. So PAN is not required for the payment of the specified income where the non-resident is able to provide the specified information. So to that extent, there is relaxation. For other than these payments, 206AA will continue to be applicable. So TRC is very much required, and the tax identification number. Now, next concept is of the grossing up. So we usually have seen there are many agreements where the particular seller or the service provider insist on the bearing of tax by the payer or service recipient or the customer. So grossing up of tax is required in those particular transactions or contracts. Now, applicable rate for the grossing up under section 195A is rates in force. Now, if say for example there is grossing up and also there is non-availability of PAN or TRC, in that case, at what rate the grossing up has to be done? Whether the grossing up has to be done at 20% or the grossing up has to be done at the rates in force. So Bangalore Tribunal in the case of Bosch Limited has taken a view that for grossing up, the rates in force should be taken up, which is say for example the treaty rate if that is beneficial and not the 20% rate. So because 195A talks about the rates in force. So grossing up, if there is no PAN or TRC, should be done at 10% or whatever the rate in force is applicable. And then TDS should be deducted at the rate of 20% on that amount, what is given under scenario 2 in this particular slide. So say for example, if the amount payable is rupees 100, rates in force is 10%, grossing up will be rupees 111.11. And TDS at the rate of 20% will be applicable on that, which will be 22.2. So that is the way the grossing up has to be done. Of course, there are other views which say that the grossing up also has to be done at 20%. So what you need to see is, first you need to see that whether the income is taxable as per the Income Tax Act. If the answer is yes, go to the tax treaty to see, okay, if the income is taxable as per the tax treaty also. Check if the tax residency certificate is available if you are taking the benefit of the tax treaty. If the TRC is not available, you cannot take the benefit of the tax treaty. Because section 90 subsection 4 talks about the mandating the TRC for claiming the treaty benefit. So section 90 subsection 4 mandate TRC for claiming the treaty benefit. However, there are decisions, a recent decision of Ahmedabad Tribunal in scraps industry which granted the treaty benefit even without TRC, because they said that the procedural obligations cannot impair the treaty benefits. Even in Hyderabad Tribunal in Srinivasa case had granted the treaty benefits even without TRC. So TRC gives us sufficient evidence for the purpose of the residency, for the purpose of treaty eligibility, but you also need to see the other conditions too. So it's not that the TRC is sufficient for treaty access. You should also comply with the beneficial ownership requirements, limitation of benefit clause, principal purpose test, which has been introduced by way of multilateral instrument. Because if these things are applicable, if the person is not beneficial owner, even if you may have TRC, the person, if he is not a beneficial owner, treaty benefit may be denied. So TRC under Circular 789, it was provided by the CBDT that TRC will be a sufficient evidence for residence and beneficial ownership, but it's not a conclusive evidence. So though Circular 789, which is providing that the TRC is sufficient evidence for residence and beneficial ownership, but you still need to obtain those requisite declarations because it is not a conclusive evidence. Circular 789 has been upheld in Azadi Bachao Andolan case. But still, now we have stringent anti-avoidance mechanism in place. So it's better to obtain these declarations. Also, if the TRC does not contain all the details, section 90 subsection 5 provides for form 10F, where the TRC does not contain all the details. So form 10F includes status, PAN, nationality, TIN, period of residential status, address, all these particular pointers are there under form 10F. It's a self-declaration form which has to be filled up and given along with the TRC. So you need to obtain the TRC and form 10F both together. Now there are certain practical concerns with respect to TRC. So what if the TRC is not available at the time of the deduction of taxes? It happens so that sometimes the TRC is available of the earlier year because TRC is applied but is not yet received, especially when you are making the payment at the start of the year itself, or when the payer is the payee is especially very new with the payer, he doesn't know about these requirements. So therefore, it usually happens in these cases that TRC is not available at the time of deduction. So ideally, the benefit of treaty provision, if you read literally section 90 subsection 4, it says that the treaty benefit will not be available. However, recently Mumbai Tribunal in very recent judgment had held that delay in furnishing DRC was justifiable for various reasons. Also, as we discussed, Ahmedabad Tribunal had allowed the treaty benefit even without TRC. Also, there is sometimes possibility that TRC is given for the calendar year and we follow the previous year and assessment year concept. In that case, the years could differ. So these are some practical challenges which are there. TRCs are sometimes submitted in some other language other than English. There are certain countries which do not have TRC. So if you see 206AA, 206AA, Rule 37 BC, which gives the relaxation for section 206AA, that if you provide TIN and TRC, there it clearly says that only if the country provides for TRC, Rule 37 BC will be applicable. So if the country does not provide for TRC, still Rule 37 BC will be applicable if you are providing the tax identification number also and the other information. But section 90 subsection 4 strictly mandates having TRC. So if the transaction is with countries where there is no TRC, there can be practical challenges because there you may not have the TRC in place and you may not be eligible to claim the treaty benefit. In those situations, what should be exactly done? Because in those situations, you do not have the TRC from the particular tax authority. So those are very challenging situations if you see. So in that case, you may obtain the particular residency certification from the tax authority, even if it is not clearly in the nature of the tax residency certificate. There could be certificate issued by the association or self-regulatory body. So that could be taken up and the self-declaration could be taken up from the particular service provider. So therefore, you need to check all these requirements before you issue a certificate in form 15CA, 15CB. Also, you need to see that whether the payments are covered as per Rule 37 BC if there is no PAN. If yes, then 206AA will not be applicable. But if the payments are not covered in Rule 37 BC and the payee does not have the PAN, in that case 206AA will be applicable and TDS will be at the higher rate. Of course, the alternative view can be taken up that 206AA will not override the tax treaty. So that is about section 195. There are certain common issues which I have compiled. So TDS on purchase of goods, whether purchase for export, that is particularly put up under the exclusions to section 911. So purchase for export, the income from that will not be deemed to accrue or arise in India. So therefore no TDS. But what about purchase for sale in India, or only purchase operations are being carried out in India, or purchase of services? In that case, TDS will be attracted. What about the export commission? So there were earlier circulars on export commission not being taxable clearly in India. There circulars which were being present, right? Now those circulars are withdrawn. So whether withdrawal of those circular would mean that export commission is taxable in India. So various decisions are there on this particular point to say that export commission will not be deemed to accrue or arise in India because it is for the purpose of these services provided outside India. They are not in the nature of fees for technical services. So there are various decisions to hold that export commission will not be taxable in India because the activities are performed outside India, and therefore these are the services which are not taxable in India. They do not amount even to the fees for technical services. With respect to royalties, there are various issues. You need to be very careful about whether a particular payment constitutes as a royalty in case of especially the softwares, whether the license is given, whether the rights are transferred, whether a particular licensed product is transferred or a license to use is transferred, because there is a recent decision of engineering analysis of Supreme Court. You need to be careful about the digitalized transactions which are there. These days we have database subscription, we have purchase of websites, we have so many other payments which are in the nature of digitalized transaction, where it is very difficult to characterize whether it is royalty or not. Use of intellectual property. So in all these cases, it is very, very essential to categorize the payment correctly, whether the same is in the nature of royalty or whether the same is business income. It's very, very important to characterize these payments. Otherwise, there could be the problem of wrong deduction of tax, right? Purchase of domain name, purchase of e-books, all these transactions needs to be characterized based on the contracts, based on the facts. You need to visit to the website of a particular service provider to see what exactly he is doing, what exactly the nature of the service could be, whether the license is transferred or whether the licensed product is transferred, whether the right to use is given, what exactly he is doing or he is giving to the service recipient. So it is very essential in these royalty payment. With respect to the fees for technical services, you need to see, okay, whether the technical services which are being provided, whether they have the human involvement, because we had the judgment of Bharti Airtel in which it was held that there should be human involvement to characterize a service as a technical service. With respect to the managerial service, a lot of DTAAs do not have the managerial services. So in that case, whether it could be business income or whether it can be other income, you need to categorize that. You need to see whether the make available test is satisfied in cases we have the make available under the DTAA, make available clause under the DTAA. So only where the service provider is making available the knowledge to the service recipient, where he is passing on the knowledge to the service recipient, in that case only the particular service will be FTS or fees for included service. In case of professional and legal service, you need to decide whether it can fall under Article 14, which is FTS, under Article 12 FTS or under Article 14 independent professional services. So characterization of the payment is very, very important. Also, when you are reading the tax treaty, it needs to be seen that the most favored nation clause is present in the treaty or not. What is most favored nation clause? If a most favored nation clause is present, MFN clause is present, then you could borrow a beneficial treaty rate from the other tax treaties. So if we have a tax treaty which contains the MFN clause, India, Netherlands, India, Switzerland have the MFN clause. And if there is a lower rate prescribed in other OECD treaty partner, then that lower rate or even the make available benefit can be borrowed and taken into this treaty. So it's very important that you read the treaty holistically. On reimbursements, we generally tend to see the reimbursement, okay, there is no cost element involved, there is no there's no profit element involved, there is no markup, so therefore no TDS. Yes, if it's a pure reimbursement, it is non-taxable because there is no markup, it is just cost to cost reimbursement which is done. But here we need to correctly identify, because there are many cases where the reimbursements have also been held to be taxable based on the facts of those cases. So it's very essential to examine the facts properly. Sometimes the reimbursements are made for the third party services. Reimbursements are made for the salary allowances. The allocation of the cost are made, and for that the reimbursements are made. So we have fallen against decision both in case of the reimbursement, and it essentially needs to be seen whether that reimbursement is taxable. It's not a straitjacket answer that reimbursement are not taxable. It's not like that. You need to see very clearly that whether what exactly is the reimbursement made for, because what is directly taxable will remain taxable even if it is reimbursed. So even if you are making the payment to the third party, but if you're showing it as reimbursement, but it is in the essentially in the nature of income, it has to be made taxable. So facts and supporting are very important. If you have supporting back-to-back supportings with that, okay, this was the cost incurred and this is what is being reimbursed. So it is very essentially required that you maintain the proper facts, you maintain proper documentation and supporting. So in reimbursement cases, it's very gray area. You need to exactly examine the facts. With respect to the withholdings on payment in kind. So if the payments in kind are made, on that also TDS need to be deducted. It was held by Andhra Pradesh High Court in Kanchanjunga Seafoods. On interest earned by NRIs, which is again very common transaction, NRO interest are only taxable. NRE interest for a FEMA non-resident is exempt. So essentially the person needs to be FEMA non-resident. NRE interest is exempt only if a person is FEMA non-resident and not as per the income tax. You need to see the residency of person as per FEMA. FCNR interest is also exempt if a person is NR or RNO. On salary payments, generally the salary payments will be taxable only if the services are rendered in India. Other issues which generally arise are, these are very common issues and common questions which arises, that what if NRI is transferring the payment from his NRO account to the NRE account? So it is essentially that I'm just transferring the money from one pocket to another pocket. So whether in that case, the TDS should be deducted? Answer is no, there is no income element. I'm just transferring the funds. It is just similar to transfer of money from one pocket to another. So TDS is not required on such transaction. However, the banks require 15 CACB. So you would have seen that many times bank insist on having the 15 CACB. Although there is no requirement of having 15 CACB because the sum is not chargeable to tax. But banks, for the want of certainty, insist for having 15 CACB. So if the CA is issuing the certificate, he should ask for the source of the funds lying in the NRO account. You can trace back what were the incomes from where the source of funds are. It could be a little bit cumbersome task, but you need to do that. You need to ask for the income tax returns filed by the NRI in the earlier years. Ask for Form 26AS, TDS certificates, documents for a particular type of income if it is reflecting. So that is very essential before you issue the 15 CB certificate. With respect to the transfers directly from the third parties into NRE's account, there of course the TDS would be required if the sum is chargeable to tax. 15 CACB may be required by the payer. The payer may also ask for 197 certificate, 195(3) certificate. He may ask for undertaking on indemnity bond from NRI. However, when the transfers are made from third parties to the NRO account, so when the transfers are made to the NRE account, there 15 CACB will be required. But if the transfer by the third party is directly made to my NRO account, in that case, again, here the sum is not getting remitted outside India. So bank is crediting the amount to NRO account, and here ideally again, the remittance certificate will not be required. But again, banks may insist on having the 15 CACB. So the payer can just obtain 15 CACB certificates and keep for the records, because essentially it is not required, but the banks may insist it. Also, there are other challenges with respect to the TDS payment. So when you especially make the payment, these days all the payments have become digitalized. So when you make the payment through credit cards, debit cards directly on websites, there you do not have the option of deducting the taxes. There you do not have any option of deducting taxes. These days, the payments are also made through Bitcoins or virtual currencies. There again, you do not have option to deduct the taxes because you're making the payment through your credit card. Also, when you go on to these websites, there is this automated payment. You add the product, you add some software, you make the website purchase, you make the IP purchase or whatever. You take the domain name, there the amount will be automatically calculated. Now, if the amount is automatically calculated, what you do exactly about the TDS? In those cases, it should be borne by you. Now, in these are really very practical challenges which are happening. In those cases, you may not be able to obtain the TRC. You may not know who is the beneficial owner, because these are the payments which are being made directly through website. You are not even interacting with the seller. So you may not have any declaration of permanent establishment in India, business connection in India. You will not have TRC, TNF, all that. And at the top of it, if the payment is chargeable to tax, you will have to bear it by your own self. So you will have to gross it up and make the TDS. Also in these cases, since the payments are happening through Bitcoins or through the credit and debit cards, the requirement of having 15 CACB gets little withered away because the banks are not insisting now. But ideally, you should be obtaining the 15 CACB certificate still. It's not that if you're making the payments to credit or debit card, the CACB certification is gone away. It's not like that. 195(6) still mandates having the 15 CACB certification if the sum is chargeable to tax. And 15 CA whether or not the sum is chargeable to tax. So in those cases also you need to maintain these documentation, because if the assessment is taken up, in that case, it needs to be demonstrated that you have complied with. Because failure to comply also has a lot of penalty consequences, which you are going to see. So these are some practical challenges with respect to TDS. Also, you need to be aware about the equalization levy, because on the transactions where equalization levy is applicable, in that case, those transactions will be exempted from income tax. So for the ad services, for the e-commerce transaction on which the equalization levy applies, income tax will not be applicable. So on that, you need to see whether the TDS will be applicable or equalization levy will be applicable in those situations. So those particular situation needs to be considered. On gifts to the non-resident relatives, on the gift to the non-resident. So again, the amendment has been introduced very recently under section 918, which talks about the gifts being made. So section 9 amendment has been a very recent amendment which has been introduced. You need to be careful about these gifts, that whether the gifts are chargeable to tax or not. So 918 says that income arising outside India, being any sum of money which is paid by a person resident in India to a non-resident, that will be deemed to accrue or arise in India. Also, you need to be careful about the foreign exchange rate. Conversion has to be done as per the rate on which the tax is required to be deducted at source, and not when it is deducted at source. On the date on which it is required to be deducted at source. And with the respect to the rate fluctuation between the date of deduction and date of payment, the difference has to be ignored. As I said, you can make an application under 195.2, payer can make an application. Under 195.3 and 197, recipient can make an application. Under 195.3, there are certain conditions. Only the eligible recipient are eligible to make an application for 195.3. Whereas under 197, anybody can make an application. So there are certain conditions under which 195.2 will be applicable. So 195.3 will be applicable. So eligible payee as per 195.3 rule 29B is foreign bank having Indian branch which is making payment for interest or any other sum. Foreign company having Indian branch which is making payment for any sum other than interest and dividend. And there are certain conditions that the income is receivable by that foreign company. That foreign company is regularly assessed to tax. It has not defaulted on any tax interest penalty. It is not doing any not doing any banking operations. It is carrying on business since last 5 years. It has fixed assets of more than 50 lakhs. And application has to be made in Form 15C for banks and Form 15D for others. Whereas under 195.2, the payer is making the application. Application by payer, as I said, is not mandatory, only where the payer is unsure about on what sum the tax has to be deducted or what is the sum chargeable to tax, only then he should make an application. And the order of 195.2 is appealable before the CITA. An application format is not there, it has to be just made on plain paper. With respect to 197, the application has to be by the SSC online in Form 13, which is application for lower rate or nil rate. Order under section 197 or 195.3 is not appealable. However, revision under section 264 can be made. Also, writ petitions can be filed in those particular cases. Then it comes up to the remittance certificate. So, as I said, 195.6 clearly says that any person who is responsible for payment of any sum, whether or not chargeable to tax, in that case, you need to furnish the remittance certificate under Form 15CA and 15CB if the sum is taxable. Rule 37BB contradicts it. It says that only when the sum chargeable to tax. However, 195.6, the section says that whether or not sum chargeable to tax. So essentially, the section prevails which says that whether or not sum chargeable to tax, you have to report. Under Form 15CA Part A, reporting has to be done where the remittance does not exceed ₹5 lakh. Where the remittances exceed ₹5 lakh and the certificate under 195.2, 3 or 197 has been obtained, you have to report in Part B. Where the remittances exceed 5 lakh and 15CB is obtained, you have to report in Part C. And where the remittance is not chargeable to tax, you have to report in Part B. 15CB will be taken where the sum is chargeable to tax. Now, question arises that form is to be submitted prior to remittance, ideally. There is no facility of correction and withdrawal, and remittance country can be different from the residence country of the payee. Form 15CA is not required for 33 listed items and for Schedule 3 of FEMA, current account regulations under FEMA. There are certain practical challenges again under Form 15CA CB, as I said, credit card payments, PayPal payments, payments to Bitcoin. In those cases, you need to still maintain this documentation even if you're not doing it through some banking channel or like direct bank. Now, what if income is taxable under the Income Tax Act but exempt under the DTAA? So in that case, do you need Form 15 CA? So income is exempt under the Income Tax Act. Oh, sorry, income is exempt under DTAA, though chargeable under the Act. So whether in that case you need to obtain 15 CA. Now 15 CA says, the 195(6) says that whether or not sum is chargeable to tax, you need to report in or need to report through 15 CA. So if, say for example, there is capital gain on sale of shares, which is not taxable due to the DTAA, it is always advisable to submit. Now whether it has to be submitted in Part C or Part D. So purpose is to provide the information. Now Part D is applicable if the sum is not chargeable to tax under the Income Tax Act. Part D is applicable if the sum is not chargeable to tax under the Income Tax Act. Whereas Part C is applicable where remittances exceed 5 lakh and certificate in Form 15 CB has been obtained. So here Part D will not be applicable because here the remittance is chargeable under the Act and not under the DTAA. Here the remittance is not chargeable as per DTAA. So here you cannot report in Part B. You will have to report in Part C. So it is always advisable to obtain the Form 15C, to furnish the information in Form 15C, obtain Form 15CB and report it in Part C. So that is very much required. Next issue which arises is what happens in the cases of losses. Say for example, if you have suffered a loss, you had done a transaction, say for example, you had purchased the shares and now you are selling at loss. In that case, in which particular form you need to report? Whether you need to report, first of all, that's the question, in which particular part you need to report. So if the transfer of shares is taking place at a loss, whether we need to report, the answer is yes, because 195(6) says that whether or not the sum is chargeable to tax, you need to report it. So even if you have losses, you need to report it. Now, if you have losses, you should report in Part D, because here your sum is not chargeable to tax under the Income Tax Act. So you can report in Part D. Is that clear? Let's take another example. Say for example, there is a Mauritius company which has paid the shareholding in Indian company. Now, say for example, there is a Singapore company which acquires the shares of the Indian company from the Mauritius company. And then Singapore company swaps the shares. So essentially there is sale of shares through swap of shares. So whether the transfer of shares from non-resident to another non-resident, or for example, where the transfer of shares which is there, where the consideration is discharged by issue of shares, whether information has to be reported under Form 15C or as per Section 195(6) read with Rule 37BB. So 195 clearly says that provision of 195 are very wide enough. So the section uses the word payment in cash or by issue of check or by any other mode. So the section is very wide enough to cover any other mode also. Also, we recently saw this, that there was Andhra Pradesh High Court decision in Kanchanjunga where it was clearly held that even where the payment is in kind, the TDS has to be deducted. However, say for example, if the transaction was not taxable, then you may furnish in Part D. But you still need to comply with 15 CACB requirements. So if the transaction is, say, for example, exempt under the Act, then Part D. If the transaction is exempt under the treaty, it is not taxable under treaty, then you may report it under Part C. However, you need to fill the particular Form 15C. It's not that you do not need to fill. Right? So 15CA will still be required. Let's take another example. If, say, for example, I have exempt payments which are which are not required to be reported, or which are under the exclusion of Rule 37 BC. If that be the case, then for the purpose of calculating that 5 lakh limit, under which part you need to report. So here, if it is less than 5 lakh, it is under Part A. So for that 5 lakh limit, whether you need to include that excluded payments also, the answer is no. Because here Rule 37 BC is very clear. It says that for the sum chargeable to tax and where the payment exceeds 5 lakh or the remittance exceeds 5 lakh. So only 5 lakh limit is applicable with respect to the sum chargeable to tax, and for the computation of 5 lakh limit, you don't need to add the exempt payments where 15CA is not required. Is that clear? Now, what are the consequences if you do not deduct taxes and if you do some wrong reporting, wrong deduction, wrong characterization? There could be disallowance of expenditure. The payer can be treated as a representative assessee under Section 163. That is very harsh consequence. If you are not deducting the taxes, if you are not withholding the taxes, the payer can be treated as representative assessee. That is what had happened in the Vodafone case also, where Vodafone was treated as representative assessee, even though the seller was Hutchinson. You still remember the case as that of Vodafone. What principally Vodafone did mistake was of not deducting the taxes. The recovery can be done from the payer because he could be treated as assessee in default. There is relief available if the NR has filed the ITR and paid the taxes. There could be interest at the rate of 1 to 1.5% per month for tax not withheld or not paid under 2011A. Penalty under Section 221 for failure to pay deducted tax. For failure to deduct tax, 271C penalty. For failure to file the TDS return, 272A plus 234F. For failure to furnish information or non-furnished or furnishing inaccurate information under 195, there is penalty as high as rupees 1 lakh. So if you fail to furnish the information under 195, there is penalty as high as 1 lakh. Also, we as chartered accountants need to be careful because furnishing of incorrect information could invite penalty of 10,000 per certificate. And there could be also prosecution for failure to pay deducted taxes. So we need to be very well aware about what exactly needs to be done. We need to see all the facts. We need to conduct proper due diligence. We need to see all the agreements, contracts, invoices, debit notes, correspondence between the parties, agreements. We need to look at the website of the non-resident to find out about their operations, what kind of services they are providing. So examination of facts is the first and foremost thing. You need to see the residential status, obtain the declaration, obtain the TRC in Form 10F, obtain the declaration of beneficial ownership, no P certificate, no poem in India. Because that way your tax liability could be changing. Ascertain the nature of the income and its characterization properly. As I said, income, whether it's royalty, whether it's FTS, whether it's business income, all that can result in change in taxability. Determine the residential status under tax treaty, determine the applicability of the tax treaty, and based on that, you can then be in a position to issue a certificate in 15C. We do not just blindly issue it. You should check the technical explanation, the MFN clause, the protocols, the LOB clause, as well as now there should be compliance with the principal purpose test, the MLI changes which are made and for the permanent establishment. Because now the anti-abuse provisions are really very harsh. We have MLI, we have CAR, we have principal purpose test, we have limitation of benefit clauses, we have indirect transfer, we have transfer pricing adjustment. So you need to be very cautious about what exactly you are issuing. So I think case studies more or less I have covered. So your answers are given, the PPT will be shared to you. And if you have any questions, I would be happy to answer. Thank you so much.
Hello, Prerna. That was really a wonderful deliberation, and some of the queries that the participants have sent, you have already answered them. But let us still have a quick view at some of them. One is non-resident is a legal heir of a residential property of parents, and what would be the applicability of TDS in case of sale of that property?
So here, as I understand from this query, the legal heir is a non-resident.
Right.
Yeah. So the property, if it has passed on to that particular legal heir, in that case, the applicability of the tax on the sale of the property, as I said, you need to determine the sum chargeable to tax, because if you need to also see whether the property is legally being inherited by that particular person, because if he is only the legal heir, or there are multiple legal heirs, and how the property has been passed on amongst the legal heir, you need to see the will. And then based on that, you need to determine, okay, if he's only the legal owner after his parents, then in that case, as I clearly mentioned, that the sale consideration will not be ideally subjected to TDS, and it will be the capital gain amount. And if it is a long term, you will have 20%. If it is short term, it will be as per the slab rate.
Right. One more is there. A person has exported goods to Africa. A person resident in Africa has helped the client for securing particular contract. Now commission has to be paid to this person. What would be the applicability of TDS on such commissions?
As I said, if the entire contract is outside India, if it is for the purpose of the activities carried out outside India, it will not be taxable in India. Because here the entire activities of the agents seem to be outside India. No part of the income or no part of the activity is being carried out in India. In that particular case, it will not be taxable.
Right. One more question is there, why section 195 excludes company word?
So 195 doesn't exclude company. It says non-resident not being a company, which means other non-resident or a foreign company. So it includes a foreign company, and it says non-resident other than company. So it means every other non-resident plus a foreign company. It's not that the foreign company is excluded.
Okay. There was a question regarding payment through credit card, but you have amply discussed that payment if the payment has been made through credit card. Okay. And there are a lot of good comments about the session. And as I had been a listener to another session of Prerna, I should admit that it was a wonderful session on TDS, on NRI payments and Form 15 CA CB certifications by CA Prerna Kishori. Who has displayed her knowledge, command, coupled with experience in handling all the related matters of the topic. Thank you, CA Prerna, for brilliant inputs to all the participants. We are really benefited a lot.
Thank you so much.
My thanks are due to CA Supriya Kumar, Chairperson of Women Members Empowerment Committee, and CA Priti Savla, Vice Chairperson of Women Members Empowerment Committee, for guiding for this event. Really, your support means a lot, ma'am. I thank all the participants for their active learning and participation, sending in queries and comments also. Your feedback really is a guiding force for us. Keep us blessing with that. I would also like to thank the coordinators, CA Manisha Mange, CA Kirti Agrawal, and all the team, including technical persons who have joined hands to make this event a success. I really thank all the people who are there in this particular program. I acknowledge the presence of CA Sudha Navandar madam in her busy schedule for this particular session also. Thanks a lot. Thanks everyone. And again, see you soon in one of the technical meets like this. And I hope Women Members Empowerment Committee keeps on their score of this Sky High Symposium high and benefiting participants like us. Thank you so much. And I request the technical support guy to please follow up the event. Thank you everyone for joining.